When a company engages in aggressive revenue recognition, it's recording a sale when it should not be recording a sale. And there's two main ways of doing this. One is to simply fabricate a sale, just to record a bogus sale that didn't actually take place. You're completely just making this up. Another way is to prematurely recognize a sale. This is a sale that's going to happen next quarter or next year, but you're moving it ahead and you're recognizing it right now. And so this video, I'm going to talk about prematurely recognizing revenue. And in the next video, I'm going to talk about bogus revenue. So let's get to work. So channel stuffing, this is a common phrase. You might have heard it. Channel stuffing, here's how this works. You've got a customer and you tell them, you know what, you should really take some more vacuum cleaners. I think we're going to sell you some more vacuum cleaners. They say, look, we have enough. Our warehouse is full of your vacuum cleaners. We really don't need any more. And you say, well, you know what? You should take some more. You should take some more vacuum cleaners. And I'll tell you what, if you don't sell the vacuum cleaners, like if you take them and you can't sell them, you can return them to us at no charge. And in fact, we'll pay the cost of return shipping. And the customer says, why are you doing this? Like, I don't even need any more vacuum cleaners. And they're like, please, just take the vacuum cleaners. We'll make it up to you later. We'll give you a discount, something like that. And basically, this company is trying to meet its quarterly sales target. And so they're just pushing this product on the customer, even though the customer is saying, look, I'm telling you, I'm going to return this stuff. I don't need it. Okay, so that's called channel stuffing. Now, so basically with channel stuffing, you are, if you can think about it, is you're stealing from a future period sales. Because what's going to happen next quarter? Normally, they would have sold through some of these vacuum cleaners and then reordered from you and said, okay, now we do need some vacuum cleaners. But you're making them so full of vacuum cleaners that they're not going to buy any from you next year. So you're taking sales from next year and you're moving them to right now. That's basically what you're doing with channel stuffing. Now, changing the date of the fiscal year end. Let's say that you have a company where the fiscal year end is December 29th usually. Okay, so that's a fiscal year end. But you move it and you change it 1 year so that now it's December 30th or let's say December 31st. So now you're getting an extra 2 days of sales in there. If you normally say, well, it's December 29th, we're going to change it. Well, this year it's December 31st because you went from December 29th of the prior year to now December 31st, you're getting that extra 2 days. And you said like, well, what does it matter? Well, if the manager is being compensated based on hitting a sales target, and they haven't hit the sales target, and that extra 2 days worth of sales is going to help them hit that target, then they would engage in this kind of dishonest behavior. Holding the fiscal year end open has to do with the following. So let's say, let me give an example. So let's say the fiscal year end is December 31st. Okay, and we say, look, at 11:59 p.m. December 31st, this is the cutoff time right here. This is the cutoff time. Any sales that take place after this, so let's say it's like 12:15 a.m. on January 1st, that is not going to be included in for the fiscal year end December 31st, okay? Let's put some dates on this, by the way. Let's say December 31st, 2020, and then on January 1st, 2021 at like, let's say 2 a.m., if a sale takes place, that would not normally be recorded for the fiscal year end December 31st, 2020, right? Because it is past the cutoff. It's like you're 2 hours late. Sorry, that's going to go in 2021 sales, okay? But if the dishonest manager says, well, you know, we're trying to hit our sales target, and at 11:59, we haven't hit the sales target yet. So guess what? We're going to hold the fiscal year open for maybe a couple more hours, maybe an entire day. They're going to pretend. And so when they write up the sales invoices and everything and the shipping documents, they're going to make it like it was shipped on December 31st, 2020, instead of what actually happened on January 1st. So they're basically going to have to, make the shipping documents and stuff. They're going to have to basically falsify them to make it look like it was on December 31st. So this is another dishonest tactic. Now, again, you're stealing from the next period because this normally, a sale at this time would have went in 2021 sales. But you took from 2021 sales to boost 2020 sales, okay? Which is, obviously, this is dishonest. But also now in 2021, you're going to have less sales. So what are you going to do? You're going to have to do it again, right? At the end of 2021, you're going to have to steal from 2022, okay? So this is what can happen when you engage in this kind of dishonest behavior. Now, recording revenue before shipment, this is just, okay, we made a sale. We haven't even shipped it out. We haven't done anything here. we got the cash from the customer. Maybe we did, maybe we didn't, but we have not shipped. Remember, normally when the product is shipped, that is normally when revenue has been recognized, right? The product is shipped out, and in some cases when the customer has actually received it. So if you've just got products sitting on a shelf and it has not been shipped, then you should not be recording a sale. Okay, generally speaking, you should not be recording a sale. So if you're recording revenue and you haven't even shipped it, that's way too aggressive, right? So wait till it's shipped. Now, shipping uncompleted products and assembling them elsewhere, I've heard of one company doing this. This is a really awful story. Basically, so they were selling products internationally. I forget what country they were selling to, so I'm just going to say that they were selling products to the Netherlands, to some customer in the Netherlands, and they did not have the product completely assembled. Obviously, the customer is going to want the product completely assembled, so they can't ship it to the customer in the Netherlands because the customer is going to be like, hey, what the heck? This isn't even assembled. So what they did was they rented a warehouse. They rented a warehouse in the Netherlands and shipped the product there. And then when it was fully assembled at the warehouse, then they give it to the customer in the Netherlands. So you say, well, why would they do that? They wanted to record the sale basically when they had shipped it to the warehouse and it wasn't fully assembled. They wanted to record the sale anyways, and they needed to be able to show the auditor some kind of shipping invoice saying, hey, we sent this product to the Netherlands. Now, of course, they're not going to tell the auditor, yeah, we just sent it to a warehouse. This isn't finalized. It still hasn't gone to the customer. They're going to make it out like, yeah, there was a customer in the Netherlands. We sent them the product. Everything's fine, right? When in reality, this product hasn't even been fully assembled yet. So again, this is a timing issue. There's an actual customer that wants the product here. This is not a fictitious sale. It's just that prematurely, they're trying to recognize the revenue now, but they have not assembled the product and given it to the customer. So that's why they're playing this game. Okay. Now, recording revenue for a full shipment when you only have a partial shipment. So let's say that the customer says they want 18 widgets, okay, and they say we got 18 widgets, and you don't have 18 widgets. You don't have them. You only have 6. So you just send them 6, and you say, well, okay, and you put on the shipping invoice, the shipping documents and everything. You put 18 so you can recognize sale for the full 18 when you only have 6. Okay, so now what's going to happen? The customer is going to receive this and say, hey, what the heck's going on? I ordered 18 of these and you only gave me 6. And you're going to say, oh, yeah, this is a mistake. Don't worry, we'll get you the other 12. Why, again, is the company doing this? They are trying to book revenue today for the full 18, even though they don't have 18 in stock. So this is a real economic transaction. There's a customer wanting 18. They just don't have 18. So they give them 6. But they book 18 as being shipped out today so they can record revenue for 18. Do you see the game that's being played here? Yeah, that's why it's premature revenue recognition. If they had just waited, then they could get revenue for the whole 18. But or just ship the 6 and then next period, when you ship the 12, recognize the revenue for that. But they are trying to book the revenue for all 18 right now. And so they're just sending out 6 and then, lying on the shipping documents. Okay. Now, announcing a price increase, that might not seem to you like premature revenue recognition. You might be like, what are you talking about? Like, companies increase their prices all the time. But so let's say it's December 31st and that's your fiscal year end and you're really trying to hit a sales target and you're not quite there, but you're close. If you tell customers, hey, so let's say it's December 31st, 2020. If you say, hey, January 1st, 2021, our prices will be going up, right? Our prices are going to go up by 20%. What is that going to give customers an incentive to do? They're going to be like, well, I better order by December 31st, 2020. So stuff that they were normally going to order in 2021, you're going to accelerate where they make the order now. So you're basically trying to get them sales that would normally take place in 2021. You're trying to get them to take place in 2020 so that you can meet your target. Now, what happens in 2021? Maybe you tell them, you know what? Hey, we were going to do a price increase, but we decided not to. So, or maybe you go ahead with the price increase. But either way, what you're trying to do is take sales that would normally occur in 2021 and shift them into 2020 so that you can hit your sales target. Now, recognizing revenue upfront for a long-term contract. Let's say that you have, let's say your company received $6 million to provide services to a company over a period of 2 years. Okay, and the company let's just say they pay you the whole $6 million upfront, and then you recognize that $6 million immediately. That's not how it's supposed to work, because if you're providing services over a 2-year period, then you should be recognizing that $6 million of revenue over a 2-year period. It shouldn't all be booked immediately, but you'd be surprised by how many companies find a way where they basically book the $6 million immediately because they're trying to hit a sales target now. Or maybe they don't book the whole $6 million, but maybe $5 million when maybe it should have been $3 million for each year. And they, so there's all kinds of games that they play here, but it's a common thing where they got this money and they're supposed to be spreading it over time, but they try and prematurely recognize that revenue and book all $6 million of it today.